Hartwu joins us, Director Sovereign Ratings at Fitch Rating Agencies, joins us from Hong Kong. Mr. Wu, good morning. Thank you for joining us. Has the possibility of a downgrade for India reduced post-reform steps taken by the government?
Well, yeah, the reform steps are certainly encouraging. So those have been encouraging developments. But at the same time, on the economic front, the economy has probably turned out to be a little weaker than we had initially expected. Growth is above 5%. And, we've seen the current account position widen also, the current account deficit position widen, which has been a negative development. So there has been a balance of both encouraging and less encouraging developments. So on balance, we still stick to our previous assessment of the negative outlook.
Do you still expect India's long-term growth prospects to deteriorate further despite positive noises on fuel and rail price hikes opening up some of sectors?
Yeah, it's a good question, but it's also very difficult to say right now at this time. There have been some measures introduced in terms of helping the reform process, and as you mentioned, in terms of FDI being increased for some sectors such as retail, power, aviation, and insurance, and those certainly will help, particularly in terms of bringing money in. But it's also difficult to say whether India's growth prospects could improve in the longer term. I think more measures may need to be introduced to help improve the competitiveness of the economy. So very early days yet.
Mr. Wu, does India's target to contain fiscal deficit in 5.3% in the current fiscal looks achievable to you?
It's looking increasingly achievable. We've gotten data in for the first 9 months of the year, and it shows that basically for the first 9 months of the fiscal year 13, the budget deficit has risen to 80% of the full year target. So there's certainly some more work to do. I think a lot will depend on two key areas. One, in terms of what the government is able to achieve in terms of divestment till the end of March, and secondly, in terms of subsidies, because there's a subsidy sharing mechanism between the government and the oil firms. So there's a bit of flexibility there to decide what they want to do. Perhaps third aspect has to do with the expenditures, because the government has made some efforts to cut down on expenditures of late, and whether they have carried that momentum into the final 3 months of the year.
So as we go into this year's budget, we are staring at current account deficit at all-time high. Does this